Right. Good afternoon, everybody. Thank you for joining us at the inaugural online James Cooper Creston Charity Summit. Hopefully we've got an interesting programme for you this afternoon, multiple speakers, as you can see. The key theme of this afternoon is resilience and critically sustainability. And that covers a number of areas, whether it be financial or environmental. Both of those topics have been in the news very, very recently. Within the last couple of days, the National Council for Voluntary Organisations have published a survey which shows that in many cases, charities feel that they are being asked to backfill shortfalls in funding in public services. 73% of charities in that NCVO survey said that the funding they were getting from local or central government was not actually sufficient to meet the societal demand that they were being asked to make. In terms of sustainability more broadly and sort of the interaction with ESG thinking and policies, where does that fit in within overall organisational culture, direction, and within core charitable objectives? Only this morning in the Times, the National Portrait Gallery's new director has launched quite a passionate defence of his organisation's choice to appoint one of the large law firms as a new corporate sponsor, on the back of having effectively had to remove BP as their headline sponsor on the back of fossil fuel concerns. And obviously that has a significant impact upon the income of that organisation. Where does that actually sit in terms of the charitable objectives of, in that case, a portrait gallery? So there's a number of angles to talk about. In terms of the speakers this afternoon, I'll spend a few moments talking through financial sustainability. I have to talk about numbers. I'm a chartered accountant. It's in my contract. Moving on from that, Nick Burrows, who's a partner at Blandy & Blandy, will be looking at some relatively recent changes in the legal and regulatory framework, how those have an impact on ESG thinking, particularly around things like investments and investment policy. Following directly on from that, Sean Taylor of Canaccord Genuity will be talking about the role of ESG principles within the management of charitable funds and sort of where they sit in terms of the overall charitable objectives, and actually what does ESG look like in late 2023. Moving away from financial sustainability slightly and actually coming back to environmental sustainability at its core. What is an organisation's environmental footprint? Can you monitor that in order to be able to manage it? There we go to Richard Cartwright of the University of Southampton, who'll be talking through a bespoke tool that his team have put together, designed to enable charities, small businesses, small not-for-profits, etc., to actually put a quantitative framework around their environmental impact as a first step to building a measurable environmental sustainability programme. And then finally, just rooting back to the numbers a little bit, and something I'll talk about in my opening address, John Franklin of Pro Bono Economics will actually be looking at sort of how do you measure in numerical, in quantitative terms, the societal benefit that your charity, that your organisation brings to the table. So hopefully that's an interesting range of speakers. The question and answer panel is available in Zoom. We've already got a few Q&As in from the initial registrations, but if anything else comes to mind whilst any of us are talking, please pop the question into the chat and we'll pick them up collectively at the end. Right, next slide, please, Lizzie. Thank you. Starting off then on financial sustainability. A few months ago, the Creston UK accountancy firms issued a survey to all of our charity clients in the UK, and that's over 2,000 charities as a cohort. A few key headlines from that survey. 46% of the charities surveyed said that they had seen their non-pay costs rise by over 10% in the previous year. 78% said that their pay increases had not kept up with inflation, which was running at 10.5% at the time of the survey. 73% said that they felt they had sufficient reserves to cover development plans and to cover contingencies around changes in income or cost. To put it another way, almost 1/4 of those charities surveyed were not actually confident over their financial sustainability. And of course, sustainability of a charity's finances directly linked to sustainability of provision to service users. If that provision goes away, what happens to that beneficiary group? Next slide, please, Lizzie. In terms of some steps to building financial sustainability, inevitably, the first thing on the list is thinking about income, and critically making sure that your income streams are as broad and as diverse as they can possibly be. Essentially, don't put all of one's eggs in one income basket. This might include looking at grants, looking at public fundraising, contract commissioning, investments, as Sean will talk about later, or increasingly so, charitable trading, the shops, things like that. The other key elements of this is what's the balance between restricted and unrestricted fundraising? Unrestricted, obviously, far better for the charity generally, because you can do what you like with it. The problem here has been that historically, many major funders have been very reluctant to fund core costs, i.e. they focused almost exclusively on delivery of restricted grants or income funds. A few months ago, Children in Need became probably the first big corporate donor who actually changed their policy to allow them to give unrestricted funds. Hopefully others will follow suit in that, because charities have to cover their overhead base. They have to have finance teams and things like that. Generally, you can't fund, or you cannot fund easily out of restricted funds. Next slide, please, Lizzie. Thank you. In moving on then into impact, and I won't talk too long about this, otherwise I shall risk stealing some of John's thunder later on. Income is essential, but it's not an end in itself. The role of income in a charity is fundamentally, it's what you need to deliver charitable impact. But how do you measure that? Can a charity monitor actually which of its activities generate the highest charitable impact for every pound spent? And should sort of problems arise on the horizon, if you do find yourself in a situation where you're looking to downsize, do you have clear analysis and data over which areas of provision you can possibly reduce or even close so as to absolutely minimize the impact upon your beneficiary group? Next slide, please, Lizzie. Moving on from that into business planning. So, business planning follows straight on from strategic planning. It's absolutely critical to underpinning strategy and achieving the charity's mission. Business planning is absolutely as important to charities as it is to commercial organisations, although it gets overlooked a little bit more frequently. And business plans aren't just about money. The plan should consider key objectives, identify the actions and possibly the barriers to their achievement, as well as listing the resources and the facilities that the charity will need to fulfil them. And the business plan should then be supported by and also underpins the financial plans, which will outline the costs of all the charity's activities and the income needed to cover them. It should plan for major capital costs, so building refurbishment, vehicle replacement, etc. And the budget should also make it easier to control costs by providing an overall framework within which to measure them. Next slide, please. And finally, the big one, cash flow. To use the old adage that will be familiar to all accountants, income is vanity, surplus is sanity, and cash is absolutely king. Cash flow issues are the number one reason that businesses fail, and the risks for charities are actually no different. Balancing costs and income on an annual basis in terms of what comes through your statement of financial activities, that's important, but it is not in itself enough to guarantee solvency. The timing of inflows and cash outflows is absolutely critical. CapEx can deplete cash rather, even when the impact on the SOFA is absolutely minimal. Grants can be paid in arrears. There can be delays in commissioners paying invoices, particularly when one's dealing with either central or local government. Conversely, most charities' biggest costs, your biggest cash outflows, are your staff, who do need to be paid on time every week, every month. Having a well-considered and documented financial plan from the previous slide should make cash flow management very much easier. And a small piece of good news here is that many of the modern software packages, particularly the cloud-based platforms, actually make cash flow budgeting and forecasting very much easier than it was in the recent past. Slide, please, Lizzie. So in summary then, key points as we see it for financial sustainability. Firstly, maximise your income across all available sources. Fundraising focus should be on restricted funds wherever possible. And there's some good news, as I said, the Children in Need decision hints that some major funders are warming to the idea of unrestricted grants, perhaps more than they were a couple of years ago. Understand your why. How does your business plan and your financial plans actually tie in with your core charitable objectives? Which of your charitable activities actually generate the most impact on your beneficiaries for every pound that the charity spends? And finally, always, please manage your cash flow more carefully than you manage your SOFA. And that's everything from me.
Thanks, Mike. I am now going to talk on the investment strategy in terms of what you can and can't do as a trustee, because I think if we move along to the next slide, the principal duty you've got as a trustee, first of all, is to further the charity's purpose. You need to know what its objects are and the whole purpose of what you're doing. And following on from that, your investment decisions have got to be designed to further those purposes as well. Now, moving on to the next slide, when you've got those principal duties, what you need to do is to work out what's possible for you to do. And so the first thing you need to do if you're looking at investments is to check your governing document. If you are a company limited by guarantee or a CIO, you should have quite an easy job finding the investment powers, because they'll be set out just after the objects. Sometimes it's not quite as clear in a charitable trust deed, and sometimes it's extremely obscure in a scheme from the Charity Commission. But fundamentally, you will have some investment powers. They may be set out clearly in the document itself, or they may be implied by statute. As well as looking at what powers you've got, you also just need to check whether or not there are actually any restrictions in your governing document in what you can invest in, because sometimes there are, and you may find you've got different rules that need to apply if you've got permanent endowment. Some charities would like to add an object in relation to ESG or CSR. Generally, I don't think that's necessarily a good idea, because in order to get the Commission to agree to that, it's got to be pretty close to your existing objects. And even then, they can be quite difficult. But if you've got sufficient investment powers generally, then I don't think it adds a great deal to extend the objects to include anything that will cover ESG or CSR. So next slide, please, Lizzie. if you are looking at making those investment decisions, then obviously you need to give some thought to various issues. The crucial ones are the following ones I've set out on the slide. Trustees have always got to act within their powers. Acting outside the powers means that any protection you might have as a trustee with limited liability could be at risk. So act within your powers. You've got to know what you're talking about, in the sense that you've got to make yourself sufficiently informed. You don't have to know everything, but you've got to understand what you're doing and why you're doing it. And you've got to take account of what relevant factors there are and that you become aware of. And typically for the Commission, they then tell you you've got to ignore irrelevant factors, which you would think was perhaps a corollary of the first. You've got to act in good faith. And of course, you've got a duty of reasonable care and skill as well. The interesting thing is that you've got to make decisions that are within the range of decisions that a reasonable trustee body could make. So that means you don't have to necessarily get it right every time, but you've got to do something that other people would think was not an unreasonable decision for you to make. So you can't do something completely bonkers or off the wall, but there is a range of decisions that you can make which will be construed as fulfilling your duties as trustees, because they're perfectly reasonable ones for you to take once you've made sure you're sufficiently informed and you've taken account of all relevant factors. And of course, thinking back to the object and the charity itself, you've got to make sure the decisions you make are in the best interest of the charity. And the other thing you really need to do is to make sure you record those decisions and the reasoning behind them, because if anybody comes to question those decisions later on, you want to be able to decide or show how you made the decisions and why you made those particular decisions. And those are what the Commission calls the principles of good decision making. Now we can see next that the main guidance from the Commission, the Charity Commission, in respect of investments comes in a document catchily titled CC14, which is called Investing Charity Money, a Guide for Trustees. It's actually quite useful and relatively easy to read. It's supplemented, and there's a link within the document to the actual legal basis for what they're saying. And you may or may not want to read that as well. But CC14 is the one to have a look at first of all. So if we then go on to look at a summary of the guidance, the first thing you've got to look at is whether the investments you're considering are suitable. That's whether they're suitable for the charity for a variety of reasons. Mike was talking about the need to diversify your income. Well, you need to diversify your investments as well. You don't want all your eggs in one basket as far as investments are concerned. And you will then want to consider attitude to risk in relation to all of those different investments. You may want to have a relatively large proportion in something pretty safe, so that your risk there is low. And then on some others, you may be prepared to take a slightly higher risk in the hope of a better return. But the important thing is really to make sure that as trustees, you take advice. You may have somebody on your trustee board who can give that advice, or you and they may want to bring in a third-party expert who can give you advice and can carry out the investments for you. The other thing that you need to do is to make sure that you actually review the investments regularly. There's no point something sitting in an account for years, nobody looking at it and finding it was getting a rubbish rate of interest when you could have actually done something much more productive with it. So you need to review those investments regularly. And then there are different approaches to investing. The old-fashioned one, as it were, was simply to get the best financial return you could. So you invest it with somebody and tell them to just get the maximum out of it they can. That's tended to be moderated in more recent times, so that you can aim for a decent financial return, but avoiding, for instance, a conflict with purposes. So if your charity is set up to deal with health matters, then you can legitimately avoid tobacco and alcohol investments, for instance. If you want to get a decent return, you may want to reduce support for any sort of investments that might harm the support that you get from your investors and your benefit, your donors, or something that may harm your reputation if you're associated with it. And that's fine, because that is within the sort of reasonable bound of decisions that charity trustees can take. Or you may want to get a decent financial return, but avoid some companies specifically because you don't like the way they're behaving. Now, you need to have some sort of objective means of assessing the extent to which their ESG performance is bad. It can't really just be somebody you don't like. In fact, the chair of the Charity Commission had said in a speech last week that they would be looking more closely at people who, for instance, decided to refuse to accept gifts from what they thought of as being dodgy sources. you need to have some backing behind the decisions you make in that respect. And moving on, you can, however, look at what the Commission refers to as social investment. And that's investing your funds with a view both to getting your charity's purposes improved, so actually achieving the purposes through the investment, and also making a financial return. And that can cover a range of approaches. So, for instance, a poverty relief charity can invest in affordable housing, and a development charity can make loans to small-scale farming businesses, because, first of all, there is an extent to which they can get a financial return on those investments, although not necessarily as big as they could elsewhere. But secondly, because it then also helps achieve their charity's objectives. And previously, there were these two different definitions, which they now say are all encompassed by the term social investment. The first was program-related investment, where you were investing the money, but mainly to achieve your purposes rather than achieve a financial return. And then mixed motive investment, which was slightly further up the scale, where you were investing to make a financial return and achieve the purposes. But you would expect that to be slightly better in return than the program-related investment. So moving on, what is a financial return from a social investment? Well, in the guidance, the Commission says a social investment achieves a financial return if, in financial terms, your charity is better off from the investment than it would be if the funds or property were spent, which seemed to me in investment terms a lowish bar, that basically as long as you get something back, you're okay. However, I think it's something you can take into account when you're looking at how to invest, but I would have said that you probably need to look at something slightly better than that. So moving on to what to consider, you need to think first of all how that investment, the social investment, will actually fit with your overall financial position. What are your spending plans? As Mike said, what is your cash flow looking like? How does that investment fit in with that? Because if you're not receiving the best return you could financially from the investment, then is that going to imperil some of the other things you're expecting to try to achieve? What do you expect the investment to yield for you, both financial and in helping to achieve your charity's purposes? And you need to balance those up between them. And what are the risks that it won't deliver? If you're investing in social housing and nobody pays the rent, or if you're making a loan to a farmer who then can't pay it back, what are those risks? What impact will that have on what you can do in your other programs? So you've got to balance those up, and as I said earlier, record what your consideration of those risks yields in terms of a decision. And you've got to look at the cost of making the development, how long it's going to be for, when you can get your money out, how difficult it is to get your money out, and of course what the tax treatment is as well. And in fact, the other thing to bear in mind is that there are specific legal duties to take advice on and review social investments. So before you take any social investments, you've got to decide if you should get advice about it, consider any advice you do get, and then be satisfied that it's in the interest of the charity, taking into account, as I said earlier, what you expect to get out of it. And of course, you've then got a duty to review the charity's investments as well, on a frequent enough basis that it reflects your circumstances as a charity. So the last slide simply says, take advice. You need to make sure that you, as trustees, protect your position by understanding what you're doing, and generally, I would say, getting somebody who knows what they're doing to make the investments for you. And that's all I've got to say. Thank you.
And I think that's it to me now. Thank you, Nick, and thank you to James Campbell-Cresson and Mike for putting this on, because I think this is coming exactly the right time. And actually, I've had to change slightly what I'm going to say. Listening to Mike and following on from a lawyer is always rather scary on these. So I'm going to take you through a gallop, 10-minute gallop through ESG and investments with ESG. But I'm hopefully going to give you some sound bites as to exactly what you need to look at, and give you some clues to go away and either ask your separate advisement or go back to Mike or Nick or probably anybody on the panel, and we'll try and help you along the way. This is a webinar to help rather than direct. I think the first bit of thing I'd pick up from Nick is absolutely correct. Listening to what the lawyer says, get an investment advisor, especially when it involves anything to do with ESG or ESG principles. Quite simply because I have come across a number of trustees recently who are terribly well-meaning individuals. I myself sit on 5 national charities, and they'll give advice and they'll get paid. That is actually not legal. Unless you are a qualified advisor, you cannot give advice on investment portfolios. You can talk and you can chat, but we've come across some very large charities recently that terribly well made people. No, put your money in this, that's really good. Well, actually, no, you can't do that. So please take advice. The other one that is very timely that's come is the fact that a new piece of financial legislation was passed and went live on July 31st, which actually impacts everybody on this call, whether you realize it or not, and that is called Consumer Duty. And Consumer Duty is where the financial services industry has objectives set out by the Financial Conduct Authority to put the power back in the hands of the consumer. And that is such that anything we do for you, we must look at to ensure that we never cause any foreseeable harm. We absolutely have to look for best client outcomes at all time. Therefore, I would suggest to all charity trustees on this call, if you have not had a review from your investment manager recently, or you want a second opinion, then you should do so as soon as possible. Because as we have seen recently with a number of financial firms, and it would not be fair for me to mention them, but if you read the Sunday Times and most papers, it's all over it, is that many charity trustees were investing in ESG funds and didn't realize there were large exit fees on the other side. That has now been stopped. Well, actually, they're not stopping it until 2025, but most firms, it needs a review. So charity trustees, as Nick pointed out with the CC14, you have a liability, so you've got to have a look into it. So ESG, I think it's probably best to start and say, well, it's all about the jargon. And you can see in front of you on the screen, you're saying, what is ESG? And quite simply, it's put down as environmental, social, or governance. The way I explain it to people, environmental is about our surroundings, it's about carbon, climate, things that you hear every day in the papers. And I think we're all experiencing climate change at the moment. I've never been so wet in my life, and my garden looks like a lake. Social. Is the company doing things in the right way for its employees and its communities? And governance is, are they running themselves correctly? Now, you also have to be careful as charity trustees that when you say to your boards, what is ESG? And you say, do we want our money to do good? There probably isn't a person on that board that wouldn't say, of course we do. Well, that would be termed, and I'm sure my legal colleague on this call would turn around and say, well, that's a very leading question. Of course, people want their money to do good. But what does it boil down to? And if we have a look at the next slide, please, Lizzie. What is it all about? It is about planet and people. We're not going to get a new planet. So we've actually got to take climate transition sensibly. We've got to look at sustainability. We've got to look at the circular economy. COVID actually illustrated that to us. And for the people side of it, do we want to work with companies that are actually destroying the planet? Probably not, but we still need, because for many people right now, ESG, you could be forgiven to think that it stood for energy, security, and guns, because that's what's made a lot of money in 22 and 23. There was a very big case, and we can answer questions on it later, recently about charities investing into oil and gas. And indeed, the Methodist Church for the last 20 plus years will not invest in oil and gas, and their investments have suffered as a result. However, they're forward thinking because oil and gas isn't going to last forever, and they look at other aspects that are going to help the planet, and that will be renewable energy, in particular battery technology and sustainables. So what should you be considering when you look at this? Well, when you go and have a look at your investments, and please don't think that if it's a small amount, it shouldn't be looked after properly. No. From small acorns grow oak trees if done properly. But similarly, if you have a very large portfolio, there's no harm in splitting between the two. So the principles you should really think about is, and I'll try and give you a couple of sound bites here, is that ethical investing is also known as socially responsible investing, SRI, or sustainable investing. Again, as I said in very opening line, it's all about the jargon. But you've got to consider your timeline, and exactly as Nick recommended, you've got to go back to the beginning, look at your governance document, and look at what your timeline of your investment would be. And I would suggest to anybody on this call, you're really looking at now, from the consumer duty changes that I mentioned from July, you are only going to be offered something with a minimum of a 3-year outlook. Generally, it's going to be 5, but expect 7. So you should really be looking anywhere between a 3 and 7 year timeline. The problem we have at the moment with the way markets move, if everyone logs in every month, they get scared because everything's going up and down, and the indexes are not great. But the primary goal of wanting your money to do good, as per your objects and your governing document, it down says your primary goal is positive social environmental impact. That's going to be your goal. Very similar. If we look at, as Lizzie has just gone on to my positive inclusion screen, is that there are various forms of investing properly, and the standard approach that anybody can do. Oh, well, I don't like that, I'll exclude that. Or, oh no, they say, and if you notice, I've used the word say, your reliance on ESG scores. I'm afraid there's a massive thing out there called greenwashing, where people say that they're doing ESG, but when you actually scratch beneath the surface, it's a bit of like a resprayed car. It's a different color underneath. So you got to look at a new approach, and the new approach, before I hand over to Richard, and I imagine he's going to cover quite a lot of this up, is you've got to focus on what you want to achieve. You've got to look at opportunities going ahead. You've got to make sure that it's measured and focus on those companies offering solutions. And I think you must also be very clear on what your restrictions are. I have some charities that are very, very specific about you can't invest in that because they may build that or provide materials to build that. Please don't be afraid to say what you want. That's often what I say is you as the charity trustees are carrying that liability. And just banging on to my last slide here, you need to look at long-term and the growth themes. And everybody knows this. Electric vehicles and battery technology is not going away. We need to recycle our waste better. We need to educate better. Cybersecurity, everybody's online. Look at us this afternoon. So if you get to invest and your portfolio represents this, not only can it meet your charity objectives, but it can also meet the objectives for people and planet. And the other big one that we all look at that actually does come under ESG is robotics and AI, and that is a subject that is not going away. And I think at that point, it's probably best, and I'll wait for questions at the end, to hand over to Richard. Thank you.
Hi, thank you, Sean. Thank you, Nick. Hello, my name's Richard Cartwright. I'm here from the University of Southampton, and I'm here to provide you an opportunity, I suppose, to reflect on what Nick, Sean, and what Mike has talked about today, and for you as an organization to be able to take an active step forward in benchmarking your sustainability criteria, reporting upon it, and then hopefully taking strides forward through it in respect to the opportunity to work with the university and receive a free sustainability report. So I'll ask for the next slide, please. So sustainability reporting, what is it? Well, it's very much like producing your annual accounts, but rather than doing it in a backward-looking sense, it's an opportunity for you to look at your impacts environmentally, socially, from a governance perspective, and report on those on an annual, more likely if you're from a charitable sector and a small organization, maybe on a sort of triannual basis every 3 years, and start making a record of what you think your organization really does in a positive, but also in a negative context, how it impacts the world in respect to sustainability. We're seeking as a university to work with SMEs, but also not-for-profits and charities of any size to provide you free sustainability reports. And I know, the word free has been used, and therefore a lot of eyebrows will be raised and a lot of questions immediately asked. The reason why they are free is because they are produced in collaboration with not only staff, but also students. And one of the reasons why we want to ensure that we provide our students an opportunity to engage in this, in providing free sustainability reports, is because a lot of our students, and I love them, their commercial awareness very sadly stops at Apple, Amazon, and maybe Tesco. And that's understandable because those organizations are quite often the ones that grab all of their headlines. But of course, they don't represent the vast majority of the UK economy. And importantly, they don't recognise the important contribution that the third sector and the charitable sector has, especially in the UK. The service is free, and it's free because it's provided by students, but those students aren't just aren't allowed to run loose with your organisations. Those students are supported by accredited academics, and I am here as an account manager to make sure that that your needs are fulfilled. Could I have the next slide, please? So what is sustainability reporting? Well, it is a very similar process to producing your annual accounts, other than it's voluntary, so you don't have to do it at the moment. And we do have a number of organizations that start down the path with us and then realize that it's not for them, not necessarily ever, but this year or at that time, and that's absolutely fine. But it's a process of you looking at a framework, which is a framework governed by the Global Reporting Initiative standards, but a framework that allows you to provide some quantitative and qualitative disclosures over a number of areas where you feel that you're going to have a substantial impact, either positively or negatively, in respect to the environment, social practices, or governance. Your sustainability report is like a set of annual accounts in that you're able to produce them and publicize them. It is like a set of annual accounts in the sense that there is a relatively formal structure. It isn't like a set of financial accounts in the sense that it's not mandatory that you produce this. And unlike accounting standards, which are very defined, and the responsibility of your charity to produce them in a certain way is really strictly governed, a sustainability report is a voluntary framework, and as a result, it's much more of a two-way process. We absolutely don't want to engage in greenwashing or supporting organizations that want to achieve that. But likewise, we appreciate that you're going to be working with a student group who will have a chance to get to know your organization, but are still students. And therefore, they may not fully understand everything that they see and come across. And as a result, your final report is not sort of given to you and you have to like it or lump it. It's a final report that hopefully is produced by the students and then finalized in a dialogue between yourselves and that student group and your academic. Could I have the next slide, please? So hopefully there will be some benefits to this process. You're obviously keen to learn more about sustainability because you're on this webinar, but many of your stakeholders will be keen to learn more about your credentials, and that may be perhaps not investors and lenders if you're a charity, maybe lenders, but certainly your customers, your beneficiaries, and businesses that supply into you. Your employees, if you have them, will want to know about this sort of information, and crucially, any of your donors may also want to know about this sort of information too. And at the moment, legislation is driving the agenda in respect to public procurement practices. So if you are a charitable organization that bids to win work from various public sector bodies, be it the NHS or local authorities, this may be a credential you have in your back pocket that not only guides your internal management processes, but also helps you win some further work too. Could I have the next slide, please? We hope that getting involved in the project will yield a number of benefits. It may help you win some more work. It may help you attract a greater number of employees or whatever it may be. But we also really hope that taking a little bit of time just to take a step back and think about things will also give you that breathing space for you to think strategically about your impact on the environment and in other forms. In some ways, energy prices over the last couple of years have done this in a way that we've probably not anticipated previously, and that has heightened our awareness of our reliance on fossil fuels and the energy dependence that we have. But we hope that taking this process, taking an opportunity to step back and think, might have you thinking about other ways that you impact the environment, be it wastewater or other effluents, material usage, the way you employ people, and certainly if you're a scaling and growing charity, the way you structure yourself as an organization. And we hope that this will yield an opportunity to perhaps improve your business model, for you to at least be aware of your costs and perhaps some of the mitigations and alternatives you might be able to put in place to address those in the long term. Next slide. How are the reports produced? Well, it's sort of a three-stage process. But the reports are produced in collaboration with academic students and staff from Southampton Business School. I'm here as an enterprise fellow to help recruit organizations, but also manage the relationship over that period. The reports are produced in accordance with the Global Reporting Initiative Sustainability Standards, and we have 9 GRI accredited academics at the business school. If you're worried about other structural frameworks, because sustainability is awash with lots of different benchmarks. You've got the UN Global Goals for Sustainable Development, you've got B Corp status, you've got TCFD, you've got the GRI standards. The GRI standards is a framework which is based upon the UN Global Goals for Sustainable Development. And although these standards can look onerous, if you were to take a file or a book off the shelf, you'd see that they run to some sort of 700 pages. They are standards that are scalable to address organizations of all sizes, from micro organizations through to sort of really large multinationals. So that's why we use that particular framework. Next slide. What's involved? Well, as I mentioned, it's a three-stage process. The first stage is some general disclosures. The second stage, which is really about scaling scaling our understanding of your organization. So sort of relatively administrative questions. The second stage is what we call material impacts, which is where we will give you the 17 areas that the GRI standards cover. And we'll ask you to pick out between 3 and 5 for you to look at that you think your organization contributes substantially to in a positive or negative way. And we'll address those further, asking a greater number of questions. And the final stage is a report process, which will be drafted by the students, as I said, in a sort of two-way relationship with you and the student group and the academic, to make sure that the report's appropriate. And then that report is for you to do with what you please. We very much hope that you'll put it on your website and that you'll talk about it publicly and that you have had a very beneficial experience. But if you do just want to use it as an internal management tool, you can. We will not make the report public without your prior permission, and we likewise are happy for you to put that report, which will be delivered in a sort of Word document, into something much glossier and in your sort of house style, if that's something that you'd like to do. Next slide. In terms of who we are as your team supporting this project, the project is the brainchild of Professor Ventor in Ghana. I said we have 6 accredited GRI professionals. We actually have 9 professionals within Southampton Business School now. And you'll be working with a collection of our students who are either undertaking this for an extracurricular project or will be performing this sustainability reporting process as a part of an assessed module. In terms of next steps, for the next slide, please. If you're interested, it's just a chance for you to meet me and reach out to me and drop me a quick email or a message on here and just say, look, that sounds interesting. I'd like to know more. What I'd like to do is have a 20-minute face-to-face Teams meeting or whatever it may be, face-to-face, in person, just to talk about the project a little bit more, to help you understand why we're doing it, to address any initial questions or concerns you might have. And then my role afterwards is to guide you through the whole process. So there is no such thing as a free lunch. It's free because it's a student and staff collaboration. It is an opportunity for you to make progress and benchmark your current performance, even if you've done nothing with sustainability before, or if you're a lot further down the line, for us to measure some of the progress that you've already made. It isn't designed to be onerous. It is designed to be relatively light touch. And we very much hope that some of you on this call would like to be engaged. If you're wondering why on earth you should engage with the University of Southampton if you're based much further afield, that's not a problem whatsoever. We're delighted to work with organisations from across the country, and indeed we have done thus far on our project with the organisations that we've been working with. In fact, we've gone international. We're working with organisations in Africa and in China too. So if you're wondering why it's just the University of Southampton, please do seek other opportunities elsewhere, but don't be afraid. We're happy to commute either digitally or in person. Thank you very much.
Excellent. Thank you very much, Richard. So my name is John Franklin from Pro Bono Economics. We are a charity that uses the skills of economists and data and insight to support other organisations across the social sector. We do this a couple of ways. One is by working with one-to-one with individual charities and funders to help them measure their economic impact, and that's what I'm going to be talking about a lot today. But we also try and use those skills to support and influence change, particularly in terms of policies. So why is it that organisations approach us? If we can just go and thank you. What do we mean by economic evaluation when we talk about it? Well, essentially, it's those kinds of figures that you often see around the charity and social sector. So for every £1 spent, we generate £5 in benefits, or we can save taxpayers X million pounds per year, or the scale of this problem potentially costs the government Z millions or billions of pounds a year. It's those kinds of impacts that people are interested in when they approach us. And they're interested in those for a couple of reasons. The first one, and the number one reason, which links us back to the financial resilience theme of this session, is that they use it in generating funding. So when they're approaching funders, when they're talking to potential funders, be those trusts and foundations or high net worths, having some evidence that can talk to your wider social and economic impact can be incredibly helpful for charities in terms of generating that funding. But personally, within PBE, what we would love to see organisations using this more for is to inform those decisions. So there's kind of decisions that Mike was talking about earlier in terms of prioritising one programme over another, or looking to understand the potential returns on an investment or an investment in a programme, or an innovation in terms of changing the way a programme works. If we can get to that stage where it's being used to inform that, then that's where it really generates a lot of powerful insights. In terms of the next slide, just to quickly touch on this, the one thing I'm always keen to flag is that looking at things in terms of pounds and pence benefits is definitely not the only way to be looking at impact and talking about impact, and it's not necessarily the right or the best way of looking at impact at all. It is one part of a range of different approaches that people can use to measuring impact. And here I've got some examples on screen from other types of quantitative approaches. You don't have to put a pounds and pence value on it, but also qualitative research to understand how and why an intervention works, case studies that really kind of tell the human story of what's going on with charities. And it's really important that charities think about all of these. And we certainly wouldn't want to prioritize quantitative or economic evaluation. I think we exist and we support organizations to do that because that tends to be the one that organizations find particularly difficult to do. A lot of charities tend to struggle a bit more with the kind of quantitative and in particular that economic evaluation side of things compared to telling compelling case studies, which a lot of them do really effectively. But we wouldn't want to say that that is the only or the right way. It's important to have that kind of blend of different approaches. And I always like to make that point before I kind of end up talking too much about economic evaluation, but that's just because that's what we tend to do. So a couple of examples of bits of work that we've done. Artist Foundation supports schools, primary schools in particular, by providing an additional arts program. So they embed an art specialist who works with the teachers within the school to try and use arts to bring the curriculum to life. So they might work on history projects, on geography projects, on maths or English, and try and bring that bit of the curriculum to life by using the performing arts. And they have had an intervention that they've been working with for a long time. And for a long time, they had struggled with, well, how do we articulate what our wider social and economic impact is? And we worked them right from that kind of early stage of thinking through what are the options around this. And they attended something called our Unlocking Impact Workshop training course, which is where we combine a bit of training about what economic evaluation is all about and how that potentially helps, along with some more practical advice on specifically, okay, if you're interested in doing this for your organization, what sorts of outcome measures do you want to pick up? And here we're able to identify a particular outcome measure called the Strengths and Difficulties Questionnaire, which could be used to look at, well, what's the change in the socio-emotional outcomes for the young people that they're working with, and that has evidence linking that through to later outcomes, which we can then tie into the kind of pound and pence value economic impacts that we talk about. And that was the first time they've been able to do that and talk about their impact in those terms. And it suggested that there's potentially a really quite powerful impact from the artist program in terms of the impact that has on young people and the likely knock-on consequences from those improvements in their social and emotional outcomes. So we're able to piece that evidence together using some of their own data, some existing studies, and look at what the long-term impacts are. And they've really found that really valuable in terms of engaging new funders who previously they were very much cornered in the arts sector and funders that wanted to support the arts. Now they're managing to find and engage a much wider range of different types of funders where they can appeal more to, I guess, the hard-nosed finances of it rather than just a passion for the arts as well. The second example, which I'm going to quickly talk through as well, is national numeracy. And this was a little different because this wasn't evaluating the impact of a particular intervention, but it's far more of a kind of advocacy program where they exist to encourage more people to engage in numeracy and to be able to have the confidence to use numeracy in their everyday life. And we produced a report that drew on evidence from the OECD, a big international survey that they'd done to look at, well, what is the impact of low numeracy in terms of the likelihood of people's being in employment and also the wages that they are employed at. And there's actually pretty good evidence that there's quite a big gap and it's linked to low numeracy skills. And we assess that. We assess what the potential scale of that is in the UK for the average person with poor numeracy skills. And we're able to look at the kind of potential wider costs of that if you look across the whole cohort of them. And National Numeracy have used that as part of their wider campaigning work. And they've been pretty successful. And I wouldn't suggest that the report was the sole cause for this, but they have managed to use this as a kind of big way of introducing themselves and building a relationship with the then Chancellor Rishi Sunak, who has since kind of quoted this study on a number of occasions when he's been making policy announcements around numeracy, which have included the new 650 million multiply program to improve adult numeracy skills across the UK. So this kind of gives you just a quick flavor of the types of analysis and reports that can be produced. But I wouldn't want to pretend that it's all straightforward and easy. producing economic evaluation reports. It is not right for everyone, and it's not something that you can often do overnight. It's actually something that organizations have to think about quite carefully. And whilst there are benefits potentially to doing that in terms of supporting your case for funding, in terms of informing prioritization decisions within the organization, actually it involves an investment that you need to really think through quite carefully. And we like to think about this in terms of sitting on a spectrum where on the left-hand end, you could have very light touch approaches where you don't have to ask for much data from your beneficiaries. It doesn't cost you very much in terms of your resources internally to manage and capture all that data. But the strength of the conclusions you'll be able to make about the scale of your impact will be somewhat limited compared to a far more measurement focused approach where there are much heavier data collection requirements that possibly go beyond what you need for your day-to-day operational purposes. You really need to invest in that evidence base and the resources that you put behind it, but you can get far, far stronger conclusions about the potential scale of impact that you have. And different organizations will want to sit on different spaces on this. Sorry, you can keep clicking forwards and make the whole thing appear. I forgot this had a reveal on it. The different organizations can happily sit in different places on this spectrum. We would not say that all organizations have to be up at the measurement focused end. It really is a trade-off that organizations have to think through quite carefully. And it's something that is an investment that can potentially take years to pay off. That investment in gathering the data. But on the slide now, it's got some examples of the kinds of spaces that organizations typically tend to sit. So starting from just being able to describe what your impacts are qualitatively and potentially having a bit of evidence to back that up, to capturing basic data on the volumes of output. So how many people did you support? How many training sessions did you run? Whatever it is you do, those kind of bits of the process that you can count. That's quite a common measurement activity that occurs, through to starting to gather outcomes. So understanding, well, what impact has this had for the people that we're working with in terms of can we evidence where they started, where they ended up, before when you get to the kind of really measurement focused ends of the scale, that's where you start to think about, well, can we evidence what would have happened in the absence of our intervention? So have we got some kind of comparison group or control group we can compare against to really provide that strong evidence to support a strong conclusion, like the pounds of benefits per pound spent, if you want to put it in economic terms. And for organizations, we would say there is no right place on here. What is really, really important is that you align the approach that you want to take in terms of the amount of data and evidence that you gather with your expectations of the strength of conclusion you're going to be able to make. If you are just gathering basic data on the volumes of outputs, then you're not going to be able to make a really, really strong conclusion about your wider social and economic impact. And likewise, if you're gathering lots and lots of data, you're imposing on your beneficiaries to a great extent, you write up the measurement focused end. Are you using it? Are you using that evidence to really draw those conclusions? Because if those two things are misaligned, then either you're going to be disappointed or you're putting too big an imposition on your beneficiaries for what you're doing with it. But if you can align those conclusions, the strength of conclusions you want with the type of data you're gathering, then you're in a good place as an organization. Making that informed choice is really important. And that's what a lot of our support that we provide at Pro Bono Economics is about, is helping charities, organizations to make that choice on an informed basis so they can really understand what are the types of conclusions they're likely to be able to make as a result of the investment that they're making in the data and evidence they gather. So that's a very kind of quick whip through what is a much bigger subject. If you're interested in finding out more, then please go to the PBE website and you can look up the support available to charities and funders that's out there and find out a bit more and be more than happy to have follow-up discussions if that's helpful. I'm going to stop there. I think, Mike, I'm handing back to you at this point.
Okay, yeah, thank you, John. Sorry, I was a little bit slow with my mouse clicking there. Thank you, John. Thank you, Richard. Thank you, Sean. Thank you, Nick. Lots of interesting content in there, covering quite a broad range of areas. So hopefully there was something in there for everybody. We do still have some time left for Q&A at the end. We've had one question into the online Q&A so far, which was very easy. Please, can we have a copy of the slide deck from the webinar? Absolutely. We will make sure that once the webinar's finalised, copies get sent out to all registered attendees. If anyone else has any other questions, please do drop them into the Q&A and we'll try and deal with them over the next few minutes. We had a few questions sent to us as part of the registration process. Lizzie, do you have those to hand, please?
Yes, one second. Would you like to cover off the other one while I bring that up, Mike?
Yes, that one. A question came through on the webinar chat around sort of what is the prevailing attitude around ESG investment, particularly in the US environment? Sean, that sounds like very much up your street.
Yeah, last 12 to 18 months has been difficult for ESG because if you weren't the owner of energy or big tech, 7 stocks to be precise, the Magnificent Seven, everybody will have seen their portfolios go down, and similarly inflation has had a bite. But as I said to everybody earlier, you've got to be in this for the 3 to 5 to 7 year game on your investment portfolios anyway. Also, we've had the kickback from oil and gas, so we're still we've got to stick to your guns. You've got to stick with it. Change it slightly and look at where the smart investments are sustainable are going. Thank you.
I'm actually going to stick with you, Sean, if that's okay, for the second question.
Really?
Which was
okay.
which is be helpful to have a better understanding of the cost of going to a full ESG approach to investment.
Well, for charities, your costing and your annual management charge is probably going to be no different than you for pure direct equities. It's going to have a mixture of gilts in there as well at the moment, I would suggest. So cost is relatively lower than you possibly think it is. In terms of returns, you are not surrendering performance just because you have ESG investments. And that is one of those myths that are put out there by, I won't actually say which sector puts it out there, but just because you're investing well into people and planet somehow means that you don't get a return. So cost less than you think. Many people will do fund of funds for you, so that again keeps the cost down, and much of this is done in exchange traded funds, ETFs, which brings the further cost down as well. So actually should be absolutely no different than what you're paying on your investment portfolios now, both for professional in charities and personal for your pensions. Thank you.
Thank you, Sean. I'm going to come over to you, Mike, if that's okay, with a question, which is, what will be the pros and cons of AI in the accounting and finance environment?
Okay, thank you. Really interesting question. The obvious answer is only time will tell. In terms of the immediately obvious pros of AI in relation to the accounting and finance environment, they're pretty similar whether you're looking at a corporate or indeed a charity. They're mostly around cost. If you're replacing your human finance team with mostly an AI-based solution, that AI-based solution is probably in many respects, certainly in the long term, cheaper. It doesn't attract employers' national insurance. It doesn't attract employers' pension contributions. An AI platform does not go off sick. It does not take holiday. It will operate 24/7, 365 days a year. In terms of slightly more helpful pros, John talked a little bit about sort of just the amount of data that some charities have and sort of making sure that you marshal that in the right way to be able to understand what your impact and what your charitable benefits are. And there's an obvious role for AI to play in that respect. In terms of the cons of AI in charitable finance, again, I'll go back to something that John said. the data is not the be all and end all. The point of the charitable sector is there is a human impact on this. There is a societal impact. Many of our beneficiaries, our service users, are amongst the most vulnerable members of society. One should not clearly be making decisions upon sort of service provision to people like that solely based on the data. There is a human, there is a moral angle of this, which, as far as I'm aware, is still some way away from where AI is at the moment.
Did you want to chip in there, Sean?
Yes, I've just thought of that there are 4 misconceptions that I think pull all this together. Is that one, that all ESG investment approaches are the same. That's a misconception. 2, sustainable investing sacrifices a return. That's a misconception. Sustainable investing is too risky for a charity. That's a misconception, absolutely, because it meets objectives. And the misconception 4 is sustainable investing doesn't actually make an impact. Yes, it does. That's a misconception.
Excellent, thank you. Thanks both for that. One question for Nick then, which to finish off our Q&A today, if that's okay. So we've got a question come in that says, I am a chair of trustees. We are in our 25th year tackling loneliness and social isolation. The last 13 as a charity and limited company. I'm interested in discussing advantages and disadvantages in moving to other charity structures without losing flexibility. Is that something you'd be able to cover today, Nick, or a quick brief overview perhaps?
Yes, it is. I think it's interesting. As a charity and a company, you have the advantage of limited liability, which has many significant benefits. The first of which is that the company itself, the charitable company, can enter into contract in its own name rather than in the name of the trustees. So I would have said there are, strictly speaking, 2 ways you could go. One is to move back to a charitable trust, which I would not advise because you lose that advantage of corporate identity and of limited liability. And the other way that you could go is to move to being a CIO, a charitable incorporated organization. It's possible to do that. We're doing it for a client at the moment. I wouldn't say there are massive advantages for doing it, in the sense that you're moving to a different type of limited liability organization, and probably the most significant benefit would be that you're not then subject to Companies Act, so you don't have to file accounts at Companies House, only at the Charity Commission. Other than that, it's a relatively limited advantage, I think. It might be worth doing, but I'm not sure it would actually give you sufficient advantages to make it worthwhile. It's certainly something that some are discussing, but I'm not sure that it's a massive advantage to do that. That's it.
Excellent, thank you, Nick. I think that brings us to the end of the questions. If you would like to close the webinar, Mike.
Okay. Thank you very much again to all of our speakers for giving up their time, both this afternoon, but also in the weeks that it's take to prepare the seminar. I thought there was some really interesting content in there, so thank you very much. And hopefully the people listening at home and in their offices found it just as useful and informative. We are all engaged in this sector. We're all interested in this sector. So although the slides and the webinar will be broadcast to attendees afterwards, if there are any questions that you think of after we're done this afternoon, please do get in touch, and we'll hope to see you at another JCK seminar in the very near future. Thank you very much, everyone. Good afternoon.
Thanks. Bye-bye.